What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Joining the podcast this week is my colleague Stephen Gregory, who heads up the quantitative research team at Piper Sandler.
Michael, Happy New Year. We're back 2026, and we just got through the first week of January, and we did our annual ritual of coming up with an outlook. How are you feeling after so much work that goes into that?
Good. Got some energy back from investors coming into the new year. It seems it gets quiet in those last few weeks of December and almost gets boring. And the last couple of years has been anything but boring. So it made it feel maybe even that much more quiet. So it's good to get some energy back. Plenty of news flow this week. We got payrolls. We had a bunch of announcements from the Trump administration. And the markets started off with a nice cyclical tilt to it. Feeling pretty good. We did our outlook the first week of the year, which you and I have been doing for, what is this, the 16th year in a row or something like that.
It's been quite a few years.
So yeah, we feel pretty good coming into this year. I think there's definitely still plenty of reasons to remain constructive. Our overall message is, we believe, I guess our base case is that we can maintain this Goldilocks backdrop as we continue to see some more participation in the market and the economy. The question is going to be, of course, will interest rates remain contained? There's so many stimulus measures that are already helping the economy and continue to be announced. It almost seems like, if you think about, obviously, the affordability is the big buzzword today, and everything coming out of the Trump administration is really aimed at helping to heal affordability. And the latest news announcement over the weekend was Trump announcing that he's going to try to somehow cap interest rates on credit cards, which, are at 20%. Clearly that's aimed at affordability and middle to lower income folks. So there's a lot of potential and current tailwinds here. And I think most clients I've spoken with so far, whether it's getting feedback from our outlook call, or I was in Connecticut last week meeting with clients and had a dinner with them, and people are pretty bullish on economic activity. But for the market, there's plenty of reasons where there's still plenty of concerns. And we believe the biggest potential headwind to equities is, of course, if the economy does broadly pick up and we see things like oil and interest rates, which have been super accommodative the last couple of years, turn the other direction and move higher.
Yeah. So in the outlook, the central idea of the call is that we're going to see a broadening out. We're in this Goldilocks backdrop, and you're now going to see broader participation in the market. I'd love to hear you talk a little bit about that, because this idea of it not just being the Mag 7, not just being tech carrying the market, has been something people have been calling about for some time now. So I'd love to dig into the details a little bit with you. Why do you see that happening now?
Yeah, I'd say simple answer is it's our framework is giving us broad-based and corroborating evidence that things are starting to change, which when we talk about broadening nowadays, it's like the buzzword that you've heard every year at the start of the year for the last 3 years. And we've pushed back against that idea in 23 and 24 and the majority of 2025 up until September, when we started teasing out that idea that that's the outlook view of 2026. But yeah, you've really had to hold your ground, because you've had some really sharp breadth improvements and risk on periods where small caps ripped over the last few years. And each time that happened, investors got excited and started to extrapolate and expected that this is starting to happen. And I think the simple reason, when you look back at all of those periods where they were all false breakouts in terms of breadth and rotations in the market, they were all macro driven, meaning that they were all event driven. They were all about interest rates coming down, or a good CPI report, or the Fed indicating they were going to start cutting or stop hiking, going all the way back to 2023. And so you saw these big moves in markets, and they were all PE driven though. And the thing that we kept pointing to when we were pushing back on that broadening view back in the last few years was that you didn't have improving earnings expectations to extend those moves. And I think really simply, that's why they all failed. And what's different in 2026 as we came into this year is you not only had you started to see broader improvements in earnings, but you had a long list of policy stimulus measures, whether it's the fact that the Fed had already started cutting rates and had been doing so for a year, the fact that mortgage rates had been continuing to drift lower, oil prices were down double digits on a year-over-year basis for the first time coming into the beginning of the year in many years. You had all of these signals that things were starting to improve and that they would likely continue. And that's what we've seen. We've seen the earnings picture continue to broaden out. We've now seen several months in a row where point to point, small cap earnings, as an example, have expectations have outperformed larger cap. They've been moving up at a faster pace. And that's what was missing. And that's now what I think raises the floor underneath that trade to continue supporting it. And indeed, we've come into the beginning of the year, the S&P's up just under 2%, but you've got areas within the consumer discretionary space like durables and apparels that are up almost 6%. The industrial sector has done well. Capital goods are up 5%. Transportation is up 4% as an index. And there's nothing more cyclical and breadth driven than, no pun intended, than transportation. In fact, I heard Craig Johnson, our technician, mention this week that when the transports broke out to a new high, mentioning the Dow theory, and that really goes back to the idea of a broadening market signal from a technician. And so when you look at the worst performers year to date this year, it's been the worst industry group is tech, hardware, and equipment. It's down about 3%. Software is down about 60 basis points. Some of the more defensive areas like telecoms down 2%. So we've seen a pretty broad outperformance of more cyclical areas of the market, and other areas that had been outperforming strongly. They're not all necessarily down, but they're either underperforming or they're down a little bit. And part of what is different today from a year ago, 2 years ago, is not only the fact that, again, the Fed's been cutting, mortgage rates are down. We had a news announcement we heard from CNBC on Friday where the 30-year mortgage rate was quoted below 6% for the first time in many years, 5.99. So what a difference a basis point makes. And 5 handle on mortgage rates, I think, is a psychological game changer. And then you just, again, continue to hear Trump try to provide a message that is aimed at healing the affordability problems, which of course is politically motivated, but is also a positive for the economy. As long as interest rates don't spike higher and we don't have any real inflationary pickups, which I think is the real threat of this story, we could continue to see the macro story broaden out and the market reflect that in higher earnings expectations and more cyclical / value leadership. And there's a lot of data we're watching, everything from housing mortgage applications and home sales, which have been improving. The PMIs last week, again, came in with a pretty mixed bag. So there's no broad, clear evidence of that picking up yet. But again, it's a good thing because once these data points are improving, the markets have already priced it in. And then lastly, with the jobs data, the good news there is not that the jobs report was all that good. There were still plenty of job losses in cyclical areas, but the unemployment rate came down. And the other fear of investors has been that the unemployment rate is going to spike, which we've disagreed with. And the drop from 4.6 to 4.4 should allay those fears. And I think, again, that's good news because we need some softness in employment because I think that helps to keep a cap on interest rates, but we certainly don't want a sharp backdrop of a deteriorating employment.
So overall, to distill it down, all these fail moves you've seen in broadening, however you measure that, whether you're talking small versus large, over the last couple of years have been macro events. So it's been changes in the risk profile of the economy. And today you're already starting to see a more earnings driven, so like a macro foundation of a better backdrop. And that's what you need to see a sustained move of broader participation.
Yeah, it's not just sentiment driven or PE driven. It's now a combination of sentiment, which is got us to where we are, but there's now actual data points you can point to that help support this, and not only support it, but give some confidence that something is actually changing. So yeah, we are bullish this year on the cyclical areas of the economy: transportation, manufacturing, housing, and housing related. I think there's a lot of nuances to the housing story today, and we have a backdrop where home prices are likely to keep somewhat falling in some areas or remain under pressure, and that could pressure fundamentals of builders. But again, at the same time, you're now getting a lot of positives from the Trump administration that could come into fruition and help. And then outside of builders, there's obviously a huge, broad housing related part of the market and the economy, which is benefiting from both the Fed cutting rates, whether it's reduced HELOC loans. So for those people that are locked in, they probably have a lot of home equity and now could get even cheaper financing because the Fed has cut rates via a HELOC loan, which something that people hadn't talked about in 15 years because HELOCs were declining from the GFC all the way up until the last year or so. And then, of course, lower mortgage rates helps create some velocity in existing home sales. We're bullish on this cyclical story because you're finally seeing some green shoots in the housing sector. And there's nothing more bullish, as I see it, for the macroeconomy and a broadening call than seeing some housing data improve, seeing some transportation data improve. And these are things that I think investors have gotten really bearish on because they've been going straight down for 3 years. But you have to appreciate that an incremental pickup, even a small one after 3 years of bad news and deteriorating fundamentals, can have a huge impact on the market and investor psychology. And I think that's what we're beginning to see.
So, Michael, now you're starting to see housing do better, and that's the beginning of your hope framework. So that definitely gets us to the why now. With that in mind, what are the kind of high-level investment recommendations that you're talking about for the road ahead?
Yeah, so we still like U.S. equities, but I think when you think about U.S. equities in the context of the rest of the world, the S&P 500 today is obviously extremely concentrated, very growthy, has a lot of secular winners. And if we get a broadening out, the AI mega cap stocks, the Mag 7, aren't necessarily the areas that are going to see the biggest incremental improvement. So we've certainly recommended having a more broad approach or equal weighted approach. So I'd rather be focused on owning the equal weighted S&P as it skews your cyclical exposure a little bit down cap into some of those more cyclical areas outside of just tech and comm services. So that's one way to do that. Mid caps, obviously, there's more cyclicality in the mid cap space and small caps. I think you have to be a little careful within some of the smaller cap indices because there's still a lot of unprofitable companies when you look at small value, which there's a lot of broken companies. And I don't think we're going to see the type of economic boom that's necessarily going to lift all boats. So we prefer more of the mid cap area, or even within small caps, being a little more core focused to avoid some of those tails of risk. Small cap growth, you've got a lot of unprofitable companies as well, but those tend to be more speculative names, a lot of biotechs in there and things like that. So we don't want to be too skewed into risk on because we're not coming out of a broad-based downturn, like coming out of a recession. We've already got credit spreads that are extremely low, if not on some measures at all-time lows. So the outlook for the market is not that we're going to see another year of a lot of PE expansion, but more upside from the earnings picture. And just making that statement alone helps inform your positioning call. When you have PE expansion at your back, you tend to want to be more risk on and take a little more speculation because that's when PEs are going up. That's generally the best backdrop for equities. But if that's not part of the story in 2026, I think you have to ask the question, which companies are going to deliver on earnings? Because that's where you're going to see the most upside. So within sectors, industrials has done great in the last couple of years. Obviously, there's a lot of AI exposure within industrials, but think about that AI story broadening out and then combining with this backdrop of cyclical stimulus from all the benefits of the OBBB to the Fed cutting to mortgage rates and long-term rates. Otherwise, having come down over the last couple of years. Financials, I know as a sector, that's definitely an area we still like. The materials sector should also benefit from a backdrop of broader global growth, plus the AI build out. And then, of course, the consumer discretionary space, thinking about restaurants and retail and some other areas within and tied to housing have been really strong underperformers the last few years. And if we're going to see a broadening out, I think there's going to be a lot of upside in areas there that, again, benefit from everything from the fact that oil prices have more or less collapsed over the last few years. Interest rates have come down, and all the positive pro-cyclical news coming out of the Trump administration that's going to aimed at helping the consumers. In a way, Trump's interest in helping Republicans in the midterms does, I would argue, create a positive tailwind for the lower part of the K. They go hand in hand. So in a sense, I think you have that tailwind at your back if you're long this broadening trade. Around the world, when we think about cyclical exposure, of course, emerging markets tend to have a lot more cyclical exposure. Canada, Australia, countries in Europe. And the way we often think about country allocation is from a first starting point is looking at their sector exposures. In other words, if I like financials and discretionary and industrials, countries in Europe or Canada have a lot of exposure to that, much more than the S&P 500 does, or even thinking about mid caps again in the US. So from an industries perspective, we definitely want to be skewed towards industries that are more cyclical and generally have a lower valuation that could benefit from improving macro data. So everything from air freight logistics, ground transportation. Again, transportation is one of my favorite areas of the market in 2026. And even thinking about some areas of the consumer in terms of like things that are housing adjacent that can benefit from a healing backdrop in housing. And I think what a lot of investors that are stuck on that are pushing back against this view have probably been bearish on many parts of the economy for the last few years and are making statements like, oh, we're not anywhere near affordability levels of 2019, for example. But you can't wait until these things get back to those levels if they ever do. I'm sure they will at some point, but it's really the ride getting towards an improving backdrop is where you make the most money, especially early on. I think you have to put away your maybe longer term biases from the last few years and concern around the deficit in the US or the structural problems in housing or manufacturing and just say, look, are they going to get a little better this year or going to get a little worse? And if they get a little better, that's where you tend to see a lot of upside outperformance. And then for stock selection, certainly we want to have a value tilt and look for names where there's operating leverage or earning sensitivity of improvements in housing and transportation and manufacturing and other cyclical parts of the economy. So all in all together, I think our call and our recommendations are all very much in sync and line up with a healing, a broadening, a stronger economy, however you want to look at it. The risks, again, are, in my opinion, that things overheat, or the perception of the economy is it's overheating, and we see a sharp backup in interest rates. I'd say that is something that could certainly hit the market for a period of time. I think it's going to be a fun year, and there's going to be obviously a lot of news announcements. Investors are going to continue to debate and dissect all of this macro data. And I think that's what makes it challenging, interesting. And I think figuring out where we'll be in 6 months and 12 months obviously is the key.
Thanks so much, Michael. Sounds like a pretty optimistic outlook. Thank you for sharing, and Happy New Year.
Same to you, Stephen.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.